Welcome to Market Monday from the investment team in the trust department at the First National Bank. We're going to kick things off for 2025 in this first session with the economy and the data that's expected over the next couple of weeks. We'll get into the equity markets and then rates, finishing off, of course, like we usually do, with implications for portfolio positioning. So starting things off later today, we're going to get information on the Purchasing Managers Index, which is a sentiment indicator. That's expected to come in relatively flat. And in terms of factory orders and durable goods, these are demand figures, showing a slight decline. And that's particularly important when we think about big ticket items don't tend to get as many orders if investors and purchasers are thinking about potential weakness in the economy in the future that might impact the markets. Either, maybe prices will come down, so we'll hold off, or, maybe there's going to be trouble in the labor market, maybe there's going to be trouble in terms of the commercial markets, and we're not expecting revenues to be as big, so we're not ordering as many big ticket items. Those type of things could be suggested by this report, although it's interesting to note that negative 1.1% was the last reading, and now it's expected to come in at negative 0.4 for durable goods, meaning that potentially, even though it's not great, it's firming relative to the last reading. So we're going to be paying attention to that and any trend that starts to develop there. We'll get information about the trade balance, labor market, more sentiment indicators coming into the Fed meeting minutes, which Bloomberg doesn't assign a big importance to based on their little bars here, but it's going to be pretty key. The Fed delivered a 25 basis point cut last month, and we want to see under the hood, what were they talking about, what were they looking at that justifies that cut? Because internally here in our team, we're discussing and debating the wisdom and the necessity that they had for making that cut, and we don't think either one of them is true. In other words, we don't think that cut was either necessary or wise. But, with that said, we'll dig through the minutes and see what the justifications are, how those conversations went. We'll get information about inventories, and that's an important key indicator in terms of demand. Inventories shrank last time. They're expected to show more of a shrink. That suggests that sales at the retail level might be coming better, and the economy might be healthy as a result. So we'll see that. The change in non-farm payrolls is expected to come in at 160,000, and the last reading was 227,000, but these numbers can be pretty volatile and not necessarily immune to seasonal effects. In other words, toward the December period where lots of hiring happened in retail, maybe less so now. If this number does come in at only 160, it would be a significant thing because, we've been seeing very robust job growth that's been typically surprising to the upside. And in our opinion, we're likely to see a surprise to the upside again here in this non-farm payrolls coming Friday. And then, we'll get more labor market information, we'll get more sentiment, we get information on inflation, the PPI, which is expected in its you take out food and energy and you get into core, that's expected to show a rise, of 0.3%, which is bigger than the rise last month as reported. And if that were to happen, that suggests that inflation might be picking up for the producer side of the equation, although the consumer side of the equation, they're expecting it to decline slightly to 0.2% from a 0.3% rate of increase. So, the inflation picture might be a little bit muted or at least, conflicting in terms of the data, although we suspect these numbers will both come out hotter than expected based on the strength that's been persistent in the economy, even through, the end of the year. And we get more real estate market information, and that about rounds us out over the next couple of weeks. Going into the S&P 500, let us start here. The year was really good, 23.8-ish%. This chart's slightly off because of just trying to fit to the curve here. But, 2 years in a row of north of 20% gains is not something that's happened very often. The reporters have been talking about that. And, quite frankly, we were not expecting that either. However, this pattern shows something interesting. We had a lot of bad news throughout the year, and the market kept absorbing bad news and had a couple of mild pullbacks. But it's realistically, not wanting to go down. When there's bad news, it still winds up finding a way to go back up. And when there's good news, it's finding a way to go up even more. And with this type of a pattern suggests that we're going to potentially go higher and see this bull market continue, at least in the short term. And you really can't fight a bull market. When the market is doing that, when it's going up regardless of what the news environment is, and regardless of what's happening in the economy, you're thinking, okay, we have to just pay attention and let the market do what it's going to do. So we're doing that. If you look at volatility expectations, they're pretty low, although, they did spike in December and came right back down. So, we're not looking at any major potential for volatility that's different than toward the end of last year. The geopolitical situation's pretty much the same. It's interesting to see if the new administration can, in fact, broker the promised deal to end the Ukraine war. I'm pretty confident that would be a bonus for the markets in the event that conflict is ceased. But, we're going to be paying attention and we're going to see what happens. Volatility does tend to spike from low levels, so it's not the time to get complacent like we've said before. Moving into the rates market, some interesting things happened with rates last year. The Federal Reserve brought them down pretty dramatically in that rate cut cycle. And, again, we don't think necessarily that it was either warranted or wise for that to happen, but it happened. And we're looking at what's gone on the longer end of the curve. And, all of this inversion that was kind of happening for years ahead of this cycle, when they tightened, was that the yield curve was inverted, and that meant that longer maturities were trading at a lower yield than close-in maturities, and that's not a good situation. It doesn't augur a healthy economy. The reason being is, in normal market conditions, investors should be demanding a higher rate of interest in order to lend money to the government for longer periods of time, and that was not the case. Their rate cut cycle has, in fact, restored, for the most part, a positive slope on the yield curve. It's only when inside of a year that we're seeing inversion, and more importantly, the 2s and the 10s are no longer inverted, and that is a classic recession indicator. It's an indicator that was flashing red quite a few times over the past few years and for long durations. So this shows a stabilizing situation with respect to interest rates, and this is important because really, we've heard some questions from clients and other professionals asking, well, why, if the Fed is lowering rates, are longer-term rates going up? And there's a really easy answer to that. Bond yields for treasuries in particular, the treasury security is considered in many, in fact, all of the financial models that are used as the quote-unquote risk-free asset. In other words, there's considered to be no risk that the U.S. government defaults on its debt. So the only factor that gets priced in for yield for government bonds, in at least U.S. government bonds, is an inflation risk premium. And so what this curve is telling us is, with rates so low here on short-term lending rates, the longer-term rates going up says that there are inflation expectations that have risen. And in this case, in the past month, from the end of November, so over the month of December, rates went up pretty dramatically at the, 3, 5, 7, 10, 15, and 20-year portions of the curve. These are all big moves. And, we're talking about, 40 basis points, almost 50 basis points up on the longer end of the curve, which suggests that inflation expectations are sitting higher than they were coming into the month of December. And again, it's as a result of what's expected from the Fed. When we look at what the Fed's dot plot is, and this is a chart that shows, it basically they poll all of the Fed governors that are on the Federal Open Market Committee and say, where do you see our policy rate being, a year from now, 2 years from now, 3 years from now, and out over the longer term. And so the last reading, which came out in December, basically showed, okay, they believe rates are pretty flat for December. Well, that makes sense because this was given at their meeting. They already know it's a given where rates are going to be. But these gray dots are where they all landed on the last reading in September, and the yellow dots are where they landed at the meeting in December in terms of their forecast. So for 2025, the forecasted rate is up pretty substantially. And again, for 2026, the forecasted rate, the average of all these things, is up pretty substantially. It's up pretty substantially for 27, and it's also up, although less substantially, over the quote-unquote longer term, which is an ambiguous thing. But that suggests that inflation expectations are higher, and it suggests that the Fed is willing to allow inflation to run hotter than that 2% that they're talking about, and as being their policy rate. And over the longer term, they say they expect to get back down to the 2% range, but that they're not necessarily targeting that right now. And all evidence points to the fact, no, they're not targeting that right now. They're targeting more like 2.8, according to some of the econometric models that we use. Going into corporate bonds, that curve has also gone up, and you can see the slope is a bit sharper there. That indicates something also. When you see the shape of the yield curve, it's always telling you a story. And the story that this is telling us is that while inflation expectations are up a little bit higher and they expect costs of borrowing for companies to be a little bit higher over the longer term, they also expect default risk premiums to be going up as well. And this makes sense. We're coming up against something called the debt wall over this year and next year where, tens of billions of dollars in corporate debt are coming due, and this was debt that was issued when rates were down near 1% or even lower, and now money potentially is having to be refinanced at, say, if you're looking at 5-year paper, 5% almost, or maybe even close to 6% if it's 20-year bonds. So with that being the case, the thesis is some of these companies that have to refinance their debt may come into a little bit of pressure in doing so. So we'll be watching for that. Our philosophy here at the bank is to invest in high quality corporate bonds and pay attention to the cash flows and their capital structure so we can avoid any unpleasant surprises if at all possible. And in most cases it is. Corporate bonds, especially high quality corporate bonds, have an exceedingly low default rate. Down well below 1%. So, we're not overly stressed out about this, but it does reflect a changing business landscape, and it does reflect our thesis that's going to come out in our economic report later this week, where we discuss how market conditions have changed in a way where individual companies are going to have different results based on how well they manage their capital structure and based on their competitive position. All of these things are going to become more important. It's going to be a tougher environment than it's been in the so-called, a rising tide rises all ships type environment that we've had for a few decades. We think we're going to see competition become much more important in individual industries. So there will be some winners, there will be some losers, and the capital structure and how it's managed is going to be an important part of that as we go forward. So coming back to the bigger picture, what do we do here? Are we going to be overly excited that we see a market that appears poised to continue going up? Not necessarily. We can't be complacent. Again, remember, volatility can come from nowhere. But we're not short-term traders here, and we're not advising people to do that either. You look at a bigger picture. So over the past 20 years, through some of the worst market events and conditions that have ever occurred in certainly my career, the Great Recession in 2007, 2008, 2009, 2020, where the government shut down over here. The bear market in 2022 was no picnic either. But yet here we are trading at all-time highs. And, this is the outlook we want to have. We don't want to make changes in our short-term position or in our long-term position based on short-term events. We're not going to try to take money off the table and preempt a potential decline. We're not going to wait and hold for a pullback either to avoid investing. We might not be on board for a bigger move. What we're going to do is adhere to our well thought out investment plan that's methodical, systematic, and over the long periods of time that it's been in existence, shown to have worked. Disciplined investment plan is really the only way to get through changing market conditions. So if you have questions about the markets, if you have questions about, the economy, and if you have questions about what's going on and how it impacts your investment plan, or want to make changes to those plans, then let us know. We're always happy to talk. Hope you found this video useful. Have a great day.